Good morning, ladies and gentlemen. The U.S. Fed is expected to end its quantitative easing in very near future. In fact, as a matter of few days, I suppose. Then the short-term interest rate will be also raised perhaps sometime next year. And therefore, the rest of the world, particularly the emerging world, is quite nervous about the potential impacts of this U.S. Fed's policies. This morning we have the best speaker who will share his enlightening views regarding these issues. Mr. Anup Singh currently is the managing director and the head of regulatory affairs for the J.P. Morgan based in Hong Kong. Prior to taking this job, Anup has been with IMF over nearly a quarter century, and he, as a distinguished economist, he has done a lot of analytical works while he was there. Actually, he headed Asia Pacific Department and also Western Hemisphere Department. So he knows the world economy better than anyone. While he was there, he was responsible for many important emerging market supporting programs for the crisis management. So he knows policies and he knows macroeconomics and finance. And now he's in private sector, so he knows the market everyday affair. So he's the best person to tell us what's happening in the markets and what will happen in the future. Well, we are very, very fortunate to have him this morning. And with no further ado, I would like to invite Mr. Anup Singh. Please join me in welcoming.
Mr. Chairman, thank you very much. That's very kind of you for your kind remarks. Let me just say it is a privilege for me to be with all of you. But let me tell you, it's also a real personal privilege to share a table with Chairman Ilsa Kong, who is globally known for all your work and your thinking over the years. All right, so we are in an interesting world. When the Chairman asked me some time back to talk about the effects of tapering, markets were quite calm and not volatile, and I wondered whether it would be very interesting when I spoke to you. But in the last 1 week, we have seen another round of volatility. So let me start. I'm going to give you a PowerPoint presentation. It's maybe a bit long, but what I'm going to do is try to focus on 1 or 2 points on each slide and not get into all the underlying details, but leave behind some of my thoughts, some of the results of our analysis, including at the IMF, and also my perspective from being in the private sector. And then I would hope there's time to hear from you, which is actually more important for me, on how you see the current situation. So let me start with where we are and what is the context. Now, the context is very well known now, but it is historically without parallel. As economists, we have not, in the post-war period or ever, had to deal with the situation we face today, where central banks have dropped the interest rates, as you see here, virtually to zero. And on the right-hand side, many central banks in advanced countries, to stave off depression and deflation, have adopted a quantitative easing, and beyond that, having shifted their balance sheets up in a way that historically, as economists, we have not seen before. The effect on emerging markets has really been quite intense. What this tells you is, on the left-hand side, the extent to which capital flows have been driven to emerging markets, and what the bar on the left-hand side tells you is much or more of the reasons for the shift in capital flows have been due to external factors. By external factors, I mean the situation in advanced countries, their central banks, and the search, therefore, for yield. What it also tells you, the blue bar on top on the left-hand side, is the unexplained residual. It means the extent to which capital inflows have moved to emerging markets has also been somewhat without parallel. It is not explainable by what are called external factors, which is the red, and the domestic factors. What the right-hand side tells you, we all know, much of the inflows to emerging markets has been in the form of debt and not equity. Now, I think it's important at this stage to look at Korea very briefly, Mr. Chairman, because some years back, Korea was viewed as a country that would have a high beta, would have high intensity of inflows and outflows. And what is interesting is, I think we're seeing a graduation of Korea's status, that Korea has not faced the same surge of inflows and outflows that we saw in the other emerging markets. There's been a moderate and steady development in flows, both equity and bonds, and because it hasn't showed the surge and the outflow we've seen in other markets, there is a sense that as risk aversion has gone up in the world, markets have seen Korea more as a country where they would take, without the aversion, the risk that they've seen in other countries. So let's now look at the factors, if we can. What differentiates which countries these flows have been to, up and down, off and on, over the last 5 years? Let me make a few points here. The differentiation has been quite intense. What this tells you, and I wouldn't look at all the details, is in the early months after Chairman Bernanke made his announcement, there was significant effects on markets. And the point I want to make is that there was not that much differentiation in the first few months. Countries were affected in ways that you couldn't actually explain what was happening and why. But then as time went on, it is, I think, possible to get a sense as to which countries and why. And in order to get that result, at the IMF, when I was there, we looked at a number of countries and did several models to understand what are the factors that differentiates which countries had the most impact and why. And what we discovered is somewhat familiar with the thinking of at least of economists. And that is that macro fundamentals and the prospects for the growth outlook were the most important factors. And the issues here were, is the country facing inflation? What is the situation with the current account? And what is the impact on reserves? Does the country have enough reserves? These were the most important factors, as you see in this chart. What is also very important, as you see in the middle of this chart, is the prospect for growth. Markets were concerned that if there were going to be a cyclical and structural decline in growth for some emerging markets, this would further differentiate their reaction. I'll come back to this growth position a bit later in my presentation. So the macro fundamentals of inflation, the current account and reserves were among the most important factors. It's interesting because this conforms more closely with the view of economists. So let's look a bit more about this issue, the differentiation. You know that in the beginning of this impact last year, the countries that were most affected, you see on the left-hand side in red. You got Brazil, you got India, Indonesia, and others in red. And that is because markets were concerned about their current account deficits. And then later, if you look at earlier this year, the factors that differentiated the impact seemingly changed in some way. Because you see now India, Indonesia, and Brazil, having acted with some policy measures, are now on the top. And the countries that were more impacted, like Argentina, the markets were focusing more on the reserve decline rather than the current account. Now let's look at what countries have done in the last year and more in their policy responses, how to try to alleviate the impact of these shocks. Now what we know, and what this tells you, is that emerging markets have used a range of policy tools. These are the tools that as economists and as policymakers, these are the tools they have. But this tells you that monetary policy has been used probably more than other tools. And if you see which countries have used it the most, you see they've tightened monetary policy. So what countries did, for example, is, you look at India, Indonesia, and others. They recognized at the beginning that markets were concerned about inflation. And so the response these countries took was to tighten monetary policy even against the political concerns that may have existed in their countries at that time about the effect on growth. There were also countries that used foreign exchange intervention. Fiscal policy was not a tool that was commonly used in this period. I will talk more about foreign exchange intervention, but what I want to say is that in making their responses, many countries correctly focused on what they thought were the factors differentiating their situation in capital flows, and that is why those that had concerns on inflation and the current account acted on that basis. Now let's look at the effect that these policies have had. What this tells you is that interest rate actions by countries that are facing inflation, or inflation at least above the targets of the central banks, they had the intended effect in the sense that it tended to limit the depreciation of the currency, and it helped the impact on equity prices and bond yields. What is interesting is here, I'd make just one point, and that is fiscal policy was not used very much, and it did not have a statistical effect that can be observed. Now let me go on and talk a bit about foreign exchange intervention. Because obviously countries have used foreign exchange intervention. After all, you would argue, this is why central banks hold reserves. So when it is required, they can use these reserves to counter the effect from markets. What this study showed is that countries had to be very careful as to when and how much they use foreign exchange intervention. The purpose of using the tool, obviously, is to limit the impact on the exchange rate and on the depreciation. And what we found through this model is that, yes, it can help. But it's important that your fundamentals are right. If your inflation is high, your currency is not well aligned, and if you don't have enough reserves, it's not going to help you. So what we found is, yes, if your inflation is low, if your currency is not overvalued, and if your reserves are judged by markets as being adequate, then yes, intervention policies can work. But having said that, the more open your capital account is, it probably puts a limit to the extent to which you can use intervention. And therefore, what I want to again repeat in this chart is that fundamentally it's important to focus on the macro aspects, the economy's macro fundamentals. This simply repeats what I told you a short while ago. It tells you that the effect on markets depended on the current account balances of countries on the left-hand side. And it tells you that countries that had faced higher current account deficits were more affected. But it also tells you on the right-hand side, what I showed you earlier, as you strengthen those fundamentals and you reduce the current account deficits, the effect on the exchange rate of this turbulence from tapering tends to be reduced. So what are the lessons that we can draw from this experience over the past 1 year and 18 months? We know that the volatility that we have already experienced and we are experiencing this week, we must remember it affects domestic factors, which is, I would say, the macro fundamentals of the country concerned, and obviously the external factors over which emerging markets have less control. What I haven't talked about yet much is the effect on the growth outlook. I'll come back to that a bit later. But the combination of domestic and external factors affects the growth outlook for a country. And our sense is that markets are focusing on that as well. And this simply summarizes what I've said as some of the lessons. Yes, foreign exchange intervention can be stabilizing provided your fundamentals are good and reserves are viewed by markets as being adequate. But fundamentally, I think the country needs to have a credible monetary framework. And this is what we saw in terms of the effects in countries where inflation was judged by markets to be high. Also, it helps to have a deeper financial system, of course. We've also seen that in response, as countries acted with their policies, it could be effective. And again, I repeat, the countries that were most impacted, the so-called Fragile Five, 18 months ago, as India, Indonesia, and others, they acted on policies through monetary tightening and other provisions, which meant that when this turbulence resumed earlier this year, those countries generally did not experience the same impact as they had experienced the previous year. And our sense, at least from the model and from our assessment, is because they've taken policies to focus on the fundamentals. So what I'm trying to say through all this is when tapering does occur, initially the impact can be indiscriminate across countries, but very quickly it tends to change, and then it does depend on certain factors where countries can act. Let me talk a bit more about the effect on Korea. Korea is not an emerging market, but I think for Korea it's important I say a few words on this. It is really quite remarkable, in my view, that in the last 2 years, Korea has not faced a significant impact from the QE operations. Of course, there has been some impact, but it's not been anywhere near the other fragile countries. And this is because, as markets have looked at Korea in recent years, they have demonstrated that they view Korea more and more as a safe haven destination. So if this assessment is right, and it may not be right, as we are still learning as markets change, our sense is that as the QE exit were to continue, our sense is that if this QE exit is naturally and properly driven by the reality that growth is recovering in the United States and in those countries where the exit will happen. If that is the reason why the QE exit is taking place, in this case now the recovery of the US economy, which should grow by about 3% next year, our sense is that this should not affect investor confidence, and it should not affect Korea, because I do believe from the recent evidence that Korea is now graduating. It has been in the past viewed by many as a country with what is called a high capital flow beta, which means that in the past Korea has shown a lot of effect of market turbulence, but now we do see there's been greater resilience, the effect on capital flows to Korea. So there is a sense that Korea is graduating from what we had thought it was 10 years ago. Now, there are international implications of what I've been saying. And there's no one better than Chairman Il-Sak Hong who can carry forward what needs to happen in the global governance framework, international policy making, to take actions internationally that can limit the effects. Emerging markets have successfully made the case in the last 1 year that yes, QE exit will take place, but central banks in advanced countries, especially the Fed, but also the other advanced countries, United Kingdom, the ECB, the Bank of Japan, there needs to be very clear communication and market guidance from the advanced country central banks. We have to insist on that. And then there needs to be much more of a policy dialogue. I do believe the G20 this year, led by Australia and backed by the other countries, has accepted that we have to look much more systematically at the policy spillovers from monetary policy. And this is because in the 10 years before, the G20 did not look very closely at the policy spillovers from monetary policy because they believed, maybe correctly, that central banks are generally independent and central banks focus on domestic objectives. But now it is recognized, as we're seeing the effects of the tapering, that the international spillovers from the actions of advanced country central bank is so immense that yes, this does need much more of a policy dialogue. And therefore there needs to be much more dialogue between advanced countries and emerging markets, and also very much between regulators, because there are huge cross-border issues. I do believe the G20 this year, and they will have their leaders meeting, I think, next week or very soon, they have been trying to examine both the spillovers from central banks and also how to take action to ensure that cross-border flows and policies are well coordinated. And finally, there is the issue of financing options. Turbulence means that even countries that have sound fundamentals will have a need for some financing options. So we need to ensure that we do all we can to build up financing options for countries. When the global financial crisis broke in 2008, the Fed acted quickly from the United States to have swap arrangements with many countries around the world, including Korea. And as the chairman just said over breakfast, it was interesting, the larger the swap was, the less it needed to be used. And therefore the lesson is, you need to have financing options to convince markets that yes, we have an option. If it's a swap, if it's an IMF borrowing, is it Chiang Mai or something else? And my sense is that internationally, policymakers need to do more to enhance those financing options. Because at this stage, my sense is they are somewhat sporadic, and therefore this is clearly a challenge for global policymakers. Let me now go on to talk about growth issues or emerging markets. And the reason I'm doing this is because it is certainly the case that as tapering has taken place and the effects have taken place, countries have faced a decline in growth. And this has affected also market reactions. I'm going to just make a few points on this and not spend too long on it. What this chart tells you on the right-hand side is something rather interesting. It tells you in the last 3 or 4 years, most emerging markets are facing a decline in their growth outlook from where they were earlier in the decade. It tells you that close to 80 to 90%, that's a long red bar, of countries, emerging markets, their growth outlook is less than where those same countries were in 2003, 2007. What this means is that people look at the IMF for a number of things. They look at the IMF also for the growth outlook. What is interesting is the last 4 years, what this tells you is every year the growth outlook for emerging markets has been lowered year to year and also lowered compared to a projection made earlier that year. Now we know that some of this decline is cyclical, but we have to recognize and understand whether it is structural. What I mean is, we are now having to look again at what is called the middle income challenge. The middle income challenge is a very simple point. It means that when countries reach a certain level of per capita income, that has changed over time, but we saw in Latin America that when countries reach a certain level of their per capita income, they tend to face the risk of stagnation and growth. What is interesting is that this evidence has come mainly from Latin America. And when the growth rotation shifted to Asia and to Korea and Hong Kong and Singapore, Korea demonstrated many decades ago that it does not have to face that challenge. because policies were uplifting productivity. But countries that are now moving in Asia to the middle income stage, such as China, Thailand, India, Indonesia, there is a sense that there has been a lowering in their growth, and there is a fear that perhaps these countries are going to be facing the middle income challenge that Korea did not face some decades ago. And the evidence overall is such that the probability that a middle income country will face a sustained slowdown is actually quite significant statistically. That is the economic evidence. And therefore, as countries reach that stage in Asia, we have to be careful. So you look back and say, why did this happen in Latin America? What is this middle income challenge all about? Some call it the middle income trap. I want to mention this because it does affect emerging markets in Asia. It does affect how markets view them. And it's because their growth outlook has deteriorated in recent years, some of it is due to external factors. We have to recognize that there may be domestic factors also at work. Now, the one lesson that comes from Latin America, this chart's a bit complicated, but the one lesson is that the problem comes from productivity, not from the extent of factor accumulation. It's not simply the effect, do you have enough capital, do you have enough labor? For a middle income country, it comes from the efficiency of resource use, it comes from productivity. And that was a concern that Latin America had in the 80s. Now, this tells you that although there was some effect in the Asian countries that became middle income status decades ago, such as Korea, they faced only a very small effect because they were able to keep up their productivity in their economies. And therefore, the most important factor I want to leave you is that emerging market countries in Asia need to focus on the drivers of productivity. And those drivers of productivity are what we see on this chart. This comes from a model done for a number of countries. It tells you that institutions and infrastructure and macro factors are among the most important factors. Institutions are very important. And so we try to look and see how did this work for Asian countries compared to other regions, and where are the strengths and where are the weaknesses. I don't want to spend much time on this, but what I want to leave you with a thought is that there are these drivers of productivity that need to be addressed. Asia is a huge region. The countries involved, be it India, Indonesia, Thailand, Malaysia, and so on, that are now reaching middle income status, and China, the factors are quite differentiated, but they all fall within the drivers I have talked about. And therefore, I do believe that tapering is a short-term issue, but markets are looking at the effects on growth. And therefore, in Asian emerging markets, they need to look at the drivers of growth. There are many drivers of growth. It's not only what I just said. It also depends on employment, on education. We find that in many Asian countries, such as India, Indonesia, Philippines, you find that the tertiary education enrollment, for example, is weak. And this is needed for productivity. It's also very important that there is sufficient spending on research and development expenditure. China does well, but most other emerging market countries in Asia do not do well. And therefore, what I want to leave you with is that we are at a stage now where we have to recognize that a new growth model is needed for many emerging markets. We cannot depend on the advanced countries to be the main external driver of growth in emerging markets in Asia. And therefore, as Asian countries change the growth model, financial deepening is also needed across Asia. This tells you, as one example, corporate bonds outstanding. It tells you that, just one example, that in many Asian emerging markets, as you see here, financial deepening is needed, not only for reasons of inclusion, but also because of financing infrastructure and growth sectors. So my final remarks are that the fall in growth in many emerging markets in Asia is a concern. Some of it is cyclical. Some of it could be the risks of dealing with middle-income challenges. And there is a need across Asia to do much more in order to ensure that productivity can be maintained at a rate that will maintain growth, and that these emerging markets do not face a sustained slowdown that can happen, but which did not happen in Korea's case, but it can happen in other emerging markets. And this is a very important lesson, because markets will look at the growth outlook in the years to come. Thank you very much.
Okay, thank you. Well, thank you very much for very comprehensive and insightful the presentation, particularly from the macroeconomic perspective of the imminent U.S. Fed's tapering QE. Korea avoided middle-income trap, fortunately, but still we have a long way to go to join real first-rate advanced economy, although we are classified as part of advanced economy by IMF for statistical purposes since 1998, I suppose. But still we have a long way to go. For that purpose, again, the total factor productivity and all productivity is still very, very important for Korea. And what just the honor presented here will be very, very relevant for Korean policymakers as well. Well, with this, I'd like to open the floor for Q&As. Yes, Professor Hong, and I will collect 2 or 3 comments from the floor.
Thank you very much, Dr. Singh. I would like to ask you your focus of China's shadow banking. When we see during past QE period in China, there are lots of bond issuance, especially that have been quite favored by not only China's local corporation, but also including local government and so on. But at this stage, now is getting more and more problematic direction. We know that shadow banking's weight is so high in comparison with the normal banking credit and these things. So that's my first question. How do you foresee of the prospect of these shadow banking? The other one is China is taking now internationalization of RMB to achieve of rather broader economic target and the competition with the US dollar and so on. Of these future prospect of your view, I would like to ask you 2 points. Thank you.
Okay. Okay, why don't I invite one or two more questions or comments? Yes, here. Oh. Yes.
Thank you for that very excellent overview. You didn't focus a lot on Korea and actually lauded Korea for doing well, relatively speaking. But some of the lessons that I'm taking away as the challenge for Korea, I guess, is primarily in the area of the last part of your talk, which is the deepening of the financial market. Maybe I guess we still have continuing challenges with keeping up the total factor productivity as well. But following up on the previous questioner's question, Korea still has a won that's not fully convertible. And I'd like to get your opinion on the pros and cons of that, and whether you think Korea would benefit from having its won becoming fully convertible at this stage. Thank you.
Okay, good. One more question or comment? Ambassador Her.
Thank you very much for your very enlightening presentation. I have two questions. One of the things you mentioned about is the financing options. I'm not that much worried about Korea, but if QE or interest rate hike will eventually come, do you think there's any chance that this Chiang Mai initiative will actually come to be used in Asia? And second question is that you also talk about this fundamentals and the growth drivers. And there's a lot of talk about the infrastructure investment as almost a free lunch these days. And I just wonder how the market perceives the recent initiative by China. They are now talking about Asian Infrastructure Investment Fund. And this is inviting a couple of Asian countries to join this initiative. And I just wonder what's the market perception to this idea. Thank you.
Okay, that's enough for now. Yes, please.
All right, thank you very much, and I appreciate your being here and addressing these important questions. Now let's start with China and shadow banking. There are many ways in which one can look at shadow banking. On the one hand, I would say that in China, what we call shadow banking and what the People's Bank of China monitors and reports as social financing, I think they call it, much of it, almost all of it, involves actions by banks in China. This has the advantage that in China, the PBOC, the CBRC, and the other institutions, as they focus on balance sheets, what is called shadow banking in China is actually observable and numbers are available. It's important to make that point because as we look ahead, beyond where we all are today, into future internet banking or services offered by companies in America such as Walmart and others, there is in future a shadow banking which is much more difficult to monitor than what we see today. So I would say where China is concerned, the numbers, I believe, are largely known. They are reported by the People's Bank. And therefore, and it is, most of it is based on transactions by their own banks. Number two, yes, you're right, as the People's Bank of China has frequently recognized, the numbers have gone up in the last 3-4 years quite significantly. And this means that as you look at the debt, you include local governments. Yes, it has increased a lot in the last 4 years. It's been part of the stimulus that China has employed in order to keep growth where it is now. You're right in saying that these are issues that they need to address. My simple answer is that given where the numbers are for debt or implicit debt, and given the buffers that China does have in terms of reserves, in terms of its own public debt, buffers are at a stage where the issues can be addressed. I would say what is equally important, and this also is recognized by the third plenum last year, is as you look at growth over the next 5 and 10 years, as we all know in this room and in China, there is a need to change the growth model. It comes down again to infrastructure and investments from a different point of view. And I can go a bit to the last question I was asked about infrastructure. In many countries in Asia, emerging markets, they have a real problem because infrastructure investment is small. And in many countries, such as Indonesia, but also India, you look at the amount they spend on subsidies on energy. It's a big issue in Indonesia, but also India. You will find that the amount that governments spend in a subsidy on energy, much of which does not even go to the poor, that number is almost as much as a total infrastructure investment by the country. So there is a real need in many emerging markets to raise infrastructure investment. That responds to the last question. But going back to China, we're at the other side. In China, the investment ratio has reached close to 50%. That is historically unparalleled. I don't even think we have seen that. And if you look at the ratio that comes from property investment, I don't have the exact numbers, at least over 20%, that is also historically without parallel. And so the issue is other countries in Asia need to raise their infrastructure investment. In China, the challenge is to change it. Because as you look at real estate and property, you can argue what we're seeing is a problem of composition of the investment. Yes, in certain cities, capital housing is still needed because China's per capita income is not like an advanced country. But then you have to look at the composition of it and see, is the investment in the right place? So I would say across Asia and China too, where the investment and growth model needs to change, it also needs to change perhaps in another way in the other parts of Asia. So we are at a stage where we have to look at the growth model underlying countries in Asia. And I would say that is a more important factor to me than where the renminbi will be in the coming year. We know that this tapering has effect on exchange rates. Just one general comment on exchange rates. I didn't talk about that too much. As you look at the last 2 or 3 years, and the chairman will know much more than I will, we've seen a lot of impact on markets, on equities, on bond yields, on capital flows. My sense is that the effect this tapering and volatility that it has had on exchange rates, the major big exchange rates, has been much less in the last 4 or 5 years. But you could argue because of that, it is likely that the effect on exchange rates is now going to increase. And why? Because you would argue, well, the US is recovering, and therefore you could expect capital to move back, and therefore you can expect the US dollar to appreciate more than it's done so far. And Europe continues to face a problem of growth, and therefore overall it may be the case that euro has to depreciate. So all I'm saying is that the effect on exchange rates globally the last 3 or 4 years has been much less intense than the other asset prices. But now as the unevenness of the growth momentum is becoming more clear, with the US recovering quite rapidly and Europe not, it is likely that we might see more of an effect on exchange rates. Now, I don't want to predict where exchange rates will be, but all I'm saying is the effect has been small so far, and therefore it is likely that this might increase in the coming. Now, there was a question whether on the financing options, and that also applies to where Korea is concerned. Where Korea is concerned on exchange rate, it is clear that in various perspectives or dimensions, the Korea's won has appreciated quite significantly in the last year. You see it bilaterally, you see it with the yen, you see it in terms of the average. There's been a significant appreciation. What I find interesting, and I would like to hear your reactions to this, but the data I've seen and my colleagues have seen on your own export share, that the effect of this appreciation on your export market share has not been as significant as we may have expected some years back. And therefore what this means is that the productivity momentum in Korea generally remains rather strong from some points of view, because despite this significant appreciation, it has not had a corresponding effect, at least, on Korea export market share for its major products. So it's possible that you reach a stage of differentiation and branding that has carried you beyond the stage. I don't know. This is a question I want to put to you. Things might change in the coming months. Now, will Chiang Mai be used? We talked about this also at breakfast. The total amount available is $240 billion. It has not been used so far. My answer is yes. My answer is that we need to have a global governance framework that offers these financing options, and the countries use them for precaution without a crisis. The problem with these financing options is people go back to the Asian crisis and Latin American crisis and other crises, and they view the use of financing options as the signal of a crisis. And that is what makes countries convinced they should not use them. We need to develop a governance framework where financing options are used routinely, because the scale of capital in the world we live in is again without parallel. It needs financing options that are routinely used. So yes, Chiang Mai should be used. We need to more generally develop the more common use for precautionary reasons. And as the chairman was saying a short while ago, the larger the financing option you have, the less you may use it. But you need to have the option first. That's the most important.
Well, thank you very much. If I may, I would like to make the additional comments on a few things. First, AIIB,
Yes, I didn't talk about
Asian Infrastructure Investment Bank, initiated by China. I've been arguing for some time, since the Asian Monetary Fund idea came along in 1998. I thought that regional level monetary facility can be quite useful, provided the mode of operation of the regional level facility is consistent with the existing multilateral institutions, mostly IMF's mode of operation. Because IMF doesn't have sufficient enough resources, so any supplementary and complementary facility would be helpful to IMF, as long as it's not competing, as long as it's supplementary, complementary. So that's why I thought that the best interest for the rest of the world, including United States. Actually, I've been telling my friends in Washington, even at the time, and by the way, Fred Buxton supported the idea from the very beginning, is for the rest of the world's vested interest to actively participate in that regional facility, including United States, so that the facility will be operated consistent with the other multilateral institutions. So, as you know, the Lady Summers at the Undersecretary of Treasury opposed very strongly against this idea. And then, but U.S. Treasury and the Washington intellectual communities started changing the attitude later on. And now we have a Chiang Mai Initiative. Again, in Chiang Mai Initiative, I would like to see this Chiang Mai Initiative development into a full regional facility. Again, with the make sure that the Chiang Mai Initiative, now CMIM, Chiang Mai Initiative multilateralization would operate on the consistent principles with IMF. Now, this is the monetary fund. Then the AIIB. Again, I thought that U.S. government now is somehow quite reluctant to see Korea and other countries join this AIIB initiative. I would say that's wrong in the sense that Korea should participate and also U.S. should participate in it too. Just like U.S. is actively participating in ADB. And it is important to make sure that AIIB is again operating on a similar mode of operation as ADB and the World Bank. That is the important thing. Not just, and also I will tell the Chinese policymakers, don't make it an exclusive club. It should be inclusive and it should be open to others. And so that way it will help not only this region, but the whole, the rest of the world. Actually, since I have very strong feeling about this, I just wanted to make. Another point is that regarding G20 again. I've been again advocating this all along, that the G20 has mechanism, what is called the Mutual Assessment Process, MAP. And in Pittsburgh 2009, leaders agreed on framework for the balanced and the strong growth. So what I've been saying was that U.S. tapering and in the future Japanese tapering also should brought into the G20 and not to get the permission or any approval of G20, but at least inform others what will happen, because MAP is there. In Seoul, we worked so hard to agree on the what is called quantitative indicators. So we all have this, but now it's not utilized. And I personally am quite disappointed by the outcome of G20 so far. It's becoming another really more photo session and rhetorical, declaration producing. I hope that's not the case in November, Australia. But anyway, so since I have a strong view on this. Okay, Mr. Ambassador.
Thank you very much, Dr. Singh. You mentioned when you started your speech that when you have been asked by Dr. Sagong some weeks ago to come here, markets north were very quiet. Now, over the last couple of days, markets are not quiet again, are almost in turmoils. And I would like to ask your observations. Is it just a short-term correction, or do you see more fundamental structural adjustments which are going on right now and which there is more to come? Thank you very much.
Okay. Any other? Okay, as of now, maybe yes.
Well, I do believe the Chairman will have much better sense of answering your question. What you asked is actually the fundamental question that we are now dealing with. I would make 2 points here. The first is that if this QE exit that we're seeing is because growth is coming back to advanced countries, it's a growth-driven QE exit that keeps longer run rates at a certain stable level. That is a good development because the world needs that. And as you see in some countries, how exports in the last 1 or 2 months in some countries have begun to pick up. It's because they are experiencing the effects of the US recovering. That is one thing good. The second thing is that if you look at the extent to which capital had flowed to emerging markets in other countries in recent years, as I explained earlier in my presentation, some of that flow was beyond the fundamentals. It cannot be explained. And therefore there is a sense that the extent to which capital had flowed into countries in recent years defies explanation, and therefore as it moves out, it will have an effect. So I'm saying there will be effects in the weeks to come, and the effects will be greater in countries where macro fundamentals are a problem. And I think the concern is that in many countries we've seen certain financial imbalances had built up. It's not simply property and asset prices, but the concern has been in recent years as the capital came in and came in as debt and not as equity. And therefore I think many countries need a policy framework that attracts this capital in the form of equity into infrastructure and related areas where it is needed for growth and where they will stay, and it goes beyond simply the effects of the search for yield. It is a search for yield rather than a search for a growth opportunity that is a problem that we face. But I do say that this effect is going to depend again more on certain fundamentals. So far I've spoken about the macro fundamentals. It may be that the focus in the coming weeks will be something else. But I do think that yes, there will be effects, and it will depend on fundamentals, and at least so far we know what those fundamentals are. You will have a much better sense of this.
Well, I think I fully agree with what you have said. But while the audience is thinking other questions or comments, let me ask you this on behalf of our audience, and that is regarding Abenomics. What is your sense of market about this Abenomics now? When the Abenomics was first announced, and international, the community, particularly the financial market, quite positively responds to it. But now, Mr. Abe's third arrow is not really fully shot yet. And what is the market's sense of Abenomics at this point?
Well, obviously this is a very important issue for Japan. It's a very important issue for the region. It's a very important issue globally. This does not, let me just make one point which is completely unrelated to your question, but I will say this. There's no doubt Japan needs a third arrow. There's no doubt about that. And that's why the Prime Minister has made it so important. The one thing I'll say, which has not been said so far, is that that third arrow is actual structural reforms for growth. Although this has not been used by other countries, I would say many other countries, emerging markets, need that third arrow too, for their own reasons, in order to avoid this middle income challenge. But coming back to where Japan is, we're at a stage now, let's look where the numbers are. So I think most observers, including the IMF, they are seeing a growth in Japan for this year around 0.9. It's not exactly a 2, but it is 0.9. We saw the second quarter, which was a big decline compared to the first quarter. My own sense is that in many ways growth in Japan is turned positive. In many ways prices and inflation has turned positive. It's almost about the same level. And just comparing the numbers where we are today with where Japan was a few years ago is a pretty significant change. We've got positive growth, 0.9. We've got inflation also about the same, close to 1. The problem is that Japan wants more. They've made that clear. And the world wants more from Japan. And that needs more of a third arrow. And that is what I believe they are working on.
Mm-hmm. Mm-hmm. Okay. Any other questions or comments? Yes, Mr. Chairman.
Thank you very much for your enlightening presentation. My question is, I want to more focus on exchange rate. Korean won is appreciating against US dollars. I mean, the US dollar is appreciating globally, and even more, Korean won is appreciating against dollars. And especially with Japanese yen, Japanese yen is depreciating very greatly. So what's happening is Korean exports are growing in US dollar terms. However, in won local currency terms, Korean exports this year decreased. So what's happening is that to the exporters, their income is shrinking. And the Korean companies are facing the deep difficulties of making monies. I would like to have your advice that what kind of actions Korean government should take to have some effect on these exchange rate systems. Thank you.
Any other? Okay, maybe just go one by one.
Well, I'm not sure I can add anything more on that important issue. I think you're certainly correct in what you said. There has been appreciation in bilateral terms, in effective terms, and average terms. It's been quite significant in the last year in Korea. My only sense on looking at the data and the export market share is that so far the effect on Korean exports has been much less than people expected given this appreciation. And we would hope that this is because Korea has reached a stage in its productivity growth, branding and differentiation of product that allows it to have the profitability to overcome this exchange rate appreciation. But as you say, we will see more exchange rate changes. We will likely see more US appreciation, and therefore there will be further effects for countries, including Korea. I'm not sure that any country has the ability to overcome these global changes in exchange rates. It comes back to my basic point that what we do to enhance the productivity of our exports and our economies is therefore much more important now than it was some years back. When capital was coming in, and Korea did not experience that to the extent that other emerging markets did. But in many other emerging market countries, as capital was coming in, as investors searched for yield because of QE easing, many countries, I think, postponed important structural reforms. And now that the tapering is going to be taking place, and that capital is going to be probably leaving many emerging markets, it raises the importance of taking the structural reforms that their economies need, which were not taken in recent years. Now, if you look at where Korea is, I think Korea has done very well in maintaining its productivity, and therefore now that exchange rate changes probably will take place more. I think it brings the focus of the debate in Korea back into the key medium-term structural issues. That, I think, is where we are today in Korea. It needs action soon, but the effect will come some years later. These structural reforms take time to work themselves through. But it does mean that the focus, the debate in many countries, because of different dimensions of easing, must move back to looking at the growth models and productivity and the structural reforms that may be needed.
Okay. Before we close, we have the reporters there. You have any questions? Actually, the 2 or 3. Okay, the interviews are scheduled, but yes, when.
Thank you for giving opportunity to us media people to ask Mr. Singh. The recent Korean policy measures led by Finance Minister Choi is focused on allowing consumers and households to take more debt as a new engine of growth driver. I understand he expects this kind of revived growth will increase household income after all, but the initial effect now is the fast growth in household debt without showing any tangible signs of improving underlying growth momentum. So how much do you think that the recently rising concerns about household debt, how much do you agree with those kinds of concerning voices about household debt? Thank you.
Well, I think this is the effect of QE easing in many countries. There's much more in other countries than in Korea. We've seen in many other countries concerns on household debt, corporate leverage, and these concerns are going to rise in many countries as the tapering takes place. Now, coming to where Korea is, I would say that the actions the government has taken in recent months on fiscal policy, on monetary policy, is a reflection of two things. It shows that the growth globally is more uneven than we thought some months ago, I mean. It shows that despite the fact that the US is recovering, Europe is not, the global growth has been slightly lowered for this year and next year. And therefore what Korea has done is trying to increase domestic demand, which it needs to do. And I think it shows that Korea has the buffers that allow the government to take some measures, such as we've done, for the short term. And it is a factor, and it is good that Korea has the buffers that allow it to take these actions of fiscal stimulus and on the monetary policy as we've done a few days ago. This is trying to boost domestic demand, and countries can do it if they have the buffers to do it. And I do believe Korea has those buffers, that room to do it. The problems of debt have been there for a while in many countries. I think Korea has the buffers, again, to deal with them over the medium term.
Well, thank you very much. With that very positive note, we'll have to end this very useful, productive session this morning. One of the underlying the emphasis Mr. Singh presented here this morning is the importance of structural adjustments, and Mr. Abe's term, third arrow. Actually, we Korean need that as well at this point. We should be concerned with current cyclical issues and problems, but we have to be concerned with mid to long-term growth potential and the sustainable growth. So we have to do more on the structural adjustments and to enhance our total factor productivity. Well, with this note, we have to end, and I appreciate very much for your coming to Seoul and gave us a very, very insightful, analytical overview of the current state of world economy, particularly in financial markets. Please join me in thanking Mr. Thank you.